Hi there. This is the thing about SoFi. Many people, many investors complicate this business a lot. Quite a lot. But if you look at it, it's quite easy to understand. And let me explain. Right now, the market cap of SoFi is about close to $16 billion, right? Price $14 per share. Around that level. Now, why do you want to look at this company? To invest in it and make a profit, right? So you want to more than double your money in the next years. Now, how can you value this company and how can you predict if the market cap will grow more in the future? How can you do that? Well, you look at the revenue and what they have, right? You have to understand how they make money. So easy. Revenue for the last quarter, Q1 2025, was about $771 million. Right? Now, you might say that many investors say that SoFi is not a simple bank. They offer other technology services. But don't be confused. Don't be confused. Because almost close more than 90% of the revenue comes from interest income. You can see here. Revenue for Q1 2025 was $771 million. But most of that revenue came from interest income, $763 million. You can check this on the latest report, Q1 2025, and you can easily see interest income represents most of their revenue. And on this revenue, they're able to deliver for Q1, you aware of this, $71 million. Now, for the full year, 2025, so full year 2025, they expect their earnings to be around $220 million. They might deliver a higher number or lower. It depends on the economy, but around this level, $200 million. Now, if you compare their earnings, $220 million, with the current market cap, you see that doesn't make any sense of what they expect for 2025 and the current market cap. The valuation is too high. Because when you value a bank, you don't look at price to earnings. No, you look at price to book value. So, book value, what does it mean book value? Total assets minus total liabilities, or total equity is called $6.6 billion. And you take this number and compare it with the market cap. When it's below or around book value, the bank is considered to be cheap. But of course, they also have to deliver some earnings. Now, if you look at their book value or total equity, is about $6.6 billion. Compare this number with the current market cap, $16 billion, you see that, again, it's overvalued. But how come? Well, you also have to look at the other indicators. One of them is total members. SoFi right now has about 10 million members. And another important one is total deposit, which are around 27 billion. An increase from last year of 25 billion to 27 billion. So that's quite important. Now, in my view, members can have 100 million members. But if you don't have deposits, you can have a lot of accounts. But if you don't have money in those accounts, the value of the members is not that high. So focus on the total deposits. Because based on these deposits, be aware of this, 27 billion, they take this money and give loans to people. And based on those loans, they are able to earn some money, interest income. Of course, after they cover their expenses. So, to predict the future of this company, you have to see higher deposits, this number to grow more in the future, Then, based on these deposits, they originate more loans, so their loans go up, and then they're able to earn more interest income, so their net earnings will go up in the future. So you can see how easy it is to understand how SoFi makes money. Just look at this paper. When you write it down on paper, you understand much better. Now, this is the thing, how they make money and how they can grow to increase the total deposits. Now, is there about 27 billion? Just imagine how much they can grow in the future. They can grow to 100 billion from this level to go to 100 billion or even more. If you look at JP Morgan, they have in their total assets more than 1 trillion. So SoFi has a lot of room to grow if they do the right thing. But now, what's the risk? What's the risk? What's the risk? Well, to grow their deposits, they can market their platform and they can attract more deposits. Here, no risk. As long as they invest in marketing, they will attract more people. Now, the risk comes from their loans. You can see here, which are about $30.4 billion. When they originate loans, more loans, imagine, you have to know that they take the risk of default. If they lend $2 billion to some people and they can no longer pay it, they take the loss. And this is the risk with SoFi. You can see this in 1 year, 2 years, their loss is 3 years, over a longer period. And when that happens, their earnings will be affected. Because if they report a loss, that will be reflected on their income statement and their earnings will be with minus. And of course, when that happens, the stock price goes down. So they have to be very careful how they originate loans and how they handle the risk. Don't forget about this risk, their loans. Now, the good part about SoFi is that, yes, they have 30.4 billion loans on their balance sheet. They originated. But they are trying to get rid of those loans. More than half, you can see here. 18.2 billion loans are held for sale. What does it mean? They are trying to find other investors who are willing to buy their loans. And they only keep the loans that they think are much more reliable with low risk. So they get rid of the risk and keep what's safe. This is what they want to do, their strategy. Now, can they do it? Can they succeed? Of course, they can do it. But again, they also have to find the buyers for their loans, because not many investors will want to buy an unproductive loan. So here is another risk. They might not find buyers for their loans. And if they don't find, they remain with those loans on their balance sheet and they increase the risk of default. So it's easy to understand how they operate and what's the risk. Now, they are trying to improve their platform to attract more members, right? To increase this number, increase their deposits. They might offer other services, technology services, where they can charge a fee or commission. But at the end, you also have to ask yourself not only how SoFi can make money and how they can grow, you also have to ask yourself, what do the customers want? And to answer this question is quite easy. What do you want from a bank? Ask yourself, what do you want from a bank? You want zero fees, right? Low interest, and safety, right? Three important things: zero fees, low interest rates, and safety. This is all you want. And of course, convenience. To be easy to do your financial services on your app. But nowadays, every bank has to offer this digital app. So don't see it as an advantage. Everybody can do it. What matters at the end? At the end, if you look at the end, the most important things is zero fees or low fees, low interest rate on your loans, and safety. Because when you deposit your money, you want to be secure. And when you look at this, what the customers want, you can see that it's not that easy to make money based on their technology services. Yes, they might attract some people with some services, but at the end, what matters are this one: zero fees, low interest rates, and safety. And when you have more competition, because SoFi is not alone, they'll try to compete, lower their fees, offer lower interest rates, and of course safety. And you'll see that it's not that easy to compete in this industry. You might say that technology is a plus for SoFi, but also the other banks can easily implement their technology. There is no longer a barrier technology, in my view. So the moat of SoFi, what's their edge? What's the advantage of SoFi? Yes, they integrate investing, insurance, banking, financial services into one single platform. But also the other banks do the same thing. So what's left is this: zero fees, low interest rates, and safety. This is available for every bank, whether it's digital or physical. This is available. Of course, a digital bank, because they don't have those branches, physical branches, offices, they can have lower expenses and increase their earnings. Of course, that's an advantage for digital banks. But also, those physical banks can get rid of those offices in the long term. So you have to analyze how much money they make on their loans, see their losses, because they also have some non-performing loans, and then look at their total deposits, how much they can grow their assets so they can lend more money to people. This is all you have to know. And by the way, right now, SoFi is overvalued. You can see that book value is about 6.6 billion and the market cap is quite higher. So in my view, SoFi right now is not a great investment. If you want a great investment right now, you can join my portfolio and see exactly what I buy and what I sell. And more recently, I've invested in an undervalued company from the US where the potential is a 2x in almost 1 year. So that's quite a lot, quite a lot. So if you want better investment ideas with high returns and low risk, this is the most important thing, you can join my membership. Go to my profile and press join. And if you have other questions about SoFi, please let me know in the comments.